Good afternoon, everybody, and welcome to our webinar today. I'm Julie Sanderson, and I am the event director for the Toledo Regional Chamber of Commerce. And thank you for joining us today for our PPP Flexibility Act updates to loan forgiveness strategies and recovery best practices. You know, we are very fortunate about a week ago to have Kate and Sandy, and then another partner from William Vaughan do a webinar for us, but one of the things that they mentioned is things change very, very quickly. And it was just a few days after that that the president signed the Paycheck Protection Program Flexibility Act into law, which makes significant changes to the PPP loan forgiveness. So we're excited that they were able to be back here with us today to review some of those with us. I'm sure many of you have done many a Zoom call in the last couple of months, but just as a reminder, I do have everybody on mute. If you see that I don't have you on mute, please go ahead and mute yourself. That really just sort of helps reduce some of that background noise for our presenters and makes it a little bit easier for everybody else to hear. We are recording the session, so we'll make that available to everybody. I'll send the link within 24 hours of after having this done in case there's something that you need to refer to, and then that will live on our website as well. In terms of questions, feel free to use the chat box if you have a question along the way. If you want to send that just to me as the host, you can do that. If you're okay with everybody seeing your question, you can just go ahead and put that in the open box for questions. If something seems really pertinent to what is happening in the conversation, I'll go ahead and stop the presentation for that. But otherwise, if we don't get to your question, we will address all of those at the end. But really just that's it for the housekeeping items. Again, we're really excited to have our partners from William Vaughan Company here to give us this update. And so it's my pleasure to introduce our speakers, Kate Matz, Mike Hamp, and Sandy Towns, who are going to go ahead and review all this very great information with us. And I believe Sandy is going to go ahead and get us started.
Thanks, Julie. Thanks for having us back again. Good afternoon, everybody. I thank you for taking the time to be with us here today. This is just kind of a quick review of where we've been, where we are, where we're going. As everybody remembers, back in March was when nearly the entire country started shutting down, and really with very little advance notice. People had to deal with an unprecedented situation personally, as parents, as employees, as business owners. They had to figure out homeschooling and childcare issues on top of learning how to work remotely or even being unemployed. There was we were overwhelming the unemployment system at the time. Business owners had to figure out how to keep their businesses running as much as possible, either remotely from home, or working remotely from home, and you know, that situation may continue for a long time in the future, having a lot of remote workers. In fact, I'm working from home right now. In business relief activities, in April, we started getting a lot of federal legislation and some administrative provisions to assist with both businesses and individuals. The largest and most well-known of those was the Coronavirus Aid, Relief, and Economic Security Act, commonly known as the CARES Act. That included a whole host of provisions, including stimulus payments of up to $1,200 per individual, enhancements to family and sick leave programs for employees who had been affected by COVID, retirement plan provisions, including deferral of required minimum distributions, and early withdrawals from IRAs being allowed without penalty. There were also some changes to the charitable contributions rules, some employee retention credit, and deferral of payment of employer Social Security taxes without penalty as well. But the Paycheck Protection Program was one of the most popular, especially since they were not really intended to be loans at all. Paycheck Protection Program loans are not really intended to be loans. There were also the economic injury disaster loans, which were less popular because they were actually loans, except for the $10,000. And they were actually harder to obtain than the paycheck protection loans. There were also administrative provisions from the IRS that we saw at the time, including the deferral of the tax filing deadlines until July 15th. This was very helpful to employers who had had a really successful 2019 and were looking at owing a lot of taxes on April 15th. Now they were able to defer those payments until July and use those funds to help keep their businesses running or pay expenses while they were shut down. But the CARES Act, which was signed by the president on March 27th and included the PPP loans, which the SBA started accepting applications for those 1 week later on April 3rd, with initial funding of $350 billion. And this short application timeline left many unanswered questions regarding the calculation of the loan amounts and left the businesses scrambling to be the first in line for funding that everybody knew was not going to meet the demand. So the SBA and the Treasury started releasing additional guidance regarding these loans, and the first one being released on April 3rd, which was the night before the applications were to be taken. Many businesses did end up receiving the funding and were able to retain their employees and make some other allowable expenditures with the funds. More funding was added to the program to meet the demand, and in fact, applications are still being taken, and they'll be taken until June 30th. So if there's anybody who has not received a loan yet, you can still file an application to get one. Now, most businesses are into the calculations of how much of the loan will be forgiven and what documentation they'll need to provide and retain. That's what we hope to provide you with today. As we look to the future and try to manage our businesses in this new environment, many are looking at potential business model adjustments to allow for proper safety procedures for employees and customers for an unknown length of time. Business owners may need to look at forecasting and cash flow projections to see how and if they can accommodate either less revenue or fewer employees or both. There may be interruptions to their supply chain that they need to accommodate or work around. They have a workforce environment that's fully or partially virtual now, and they need to allow for more spacing between employees and have provided other safety enhancements. So there are a lot of challenges for business owners right now. Some businesses are seeing new opportunities during this time if they can quickly change their production model and to provide items that are needed in greater quantities during the pandemic. And there are other relief provisions that I haven't even mentioned, and Congress hasn't ruled out additional relief if needed. One of the recent additional provisions is the PPP Flexibility Act, which was signed on June 5th, and it made modifications to the PPP forgiveness. Next slide, Kate. So the significant changes include the 75% requirement. The requirement that 75% of the loan be spent on payroll has been reduced to 60%. The covered period in order to expend your funds of 8 weeks has been extended to 24 weeks, but 8 weeks is still an option if the business would prefer to use 8 weeks. The safe harbor to restore your staffing levels and salary levels to pre-pandemic levels has been extended from June 30th to December 31st. There are a couple of new FTE reduction exceptions to the added to the safe harbor, including your inability to rehire workers or hire similarly qualified workers, or being unable to fully staff due to federal requirements for sanitation and social distancing. For any amounts that are not forgiven that were going to become a 2-year 1% loan, that's now going to be a 5%, 5-year 1% loan. But you do have to request, if you were funded before June 5th, you do have to request that extension to 5 years from your bank, but it should be pretty easy to obtain. And they also extended the employer Social Security tax deferral provision, which was supposed to be for PPP loan recipients expire when you obtained your loan forgiveness. That's now been extended to fall in line with people who don't have PPP loans and are able to take advantage of that. There's still a lot of unanswered questions, and we're expecting more guidance shortly. But that's kind of a brief summary of the Flexibility Act changes. We're going to get into more detail now. Kate?
Thank you, Sandy. All right, so Sandy went over there for us the kind of summary of key changes that were made from the Flexibility Act. I'm going to back up a little bit and talk through forgiveness and just the concept of it. What's the calculation look like? Get into some of the details on the individual components. And with that, I'll be weaving into that these most recent changes that were made as part of the Flexibility Act as well. All right, so we boil this down into kind of 3 steps on how to calculate forgiveness. And I'm going to try to keep it fairly high level now. We'll go into a little bit more detail. And then as Julie mentioned, please feel free to add your comments and questions in the chat box, and we'll go into some of the additional details according to your specific circumstances as needed. So step 1 is really all about the dollars. So remember when you got the PPP loan, it was based off of 2.5 months worth of payroll expense. So now when you go to use these dollars, you are limited to payroll and certain eligible non-payroll expenses as far as what you can use those on to obtain forgiveness of those loan amounts that you received. So step 1 is about those dollars. Add up those payroll dollars, add up the eligible non-payroll dollars that you spent during that period, and that gets you to your total eligible cost. So that's going to be kind of your starting point for looking at how much is going to be able to be forgiven. Step 2, then, you start looking at some potential reductions that you might have to take to that initial eligible amount. So the first item is based on payroll. So again, it's the Payroll Protection Program. So the main thing that they were trying to accomplish here was provide money to companies to keep people employed and keep them paid. They were trying to alleviate the big onslaught of folks going into the unemployment system. Still happened to a great degree, but without the PPP it would have been even worse. So with that, they have put into place several different incentives to encourage people to use most of those dollars on payroll. So this first one here is this payroll 60% requirement. This originally was 75%. With the Flexibility Act, it was lowered down to 60%, and that's actually going to make it a little bit easier then to meet that threshold. So payroll divided by 60% kind of grosses up and says, this is the maximum amount of dollars that you're going to be forgiven based on the amount that you spent on payroll. Second part then of step 2 is to look at potential reductions for wages and for FTEs. So if you reduce the wages that you are paying to employees by more than 25%, you've got a potential reduction you're going to take there. If you reduce the number of FTEs that you have on hand, so the number of employees, you're going to have a potential reduction as well there too. So total eligible cost minus your wage reduction minus the FTE reduction is going to get you this modified potential forgiveness amount. That brings us then into step 3. So for step 3, you're going to do a comparison of 3 different dollar amounts. So the first 2 are the ones that you calculated out in step 2, that payroll 60% requirement and that modified potential forgiveness amount. The third thing you're going to compare to then is the PPP loan amount itself. You'll take the lesser of those 3, and that's the amount that you're going to use to apply for forgiveness. So what does this mean? Well, first off, you are going to be limited in the amount that you're forgiven to what your actual loan amount was. Can't get more forgiven than what you were given in the first place. Secondly, you've got the 60% requirement for payroll. So if you spend less than 60% of those dollars on payroll, you're going to be limited as to the amount that you can have forgiven. The third thing is, if you've got those wage reductions or FTE reductions that you had during the period, you're also going to have a reduction there. So again, lesser of those 3 amounts. Let's dive into a little bit more details now on what some of these components are. First, we'll talk about payroll. So for payroll, you've got 2 different options as far as the covered period. So you can either use the standard covered period, which is the 8 or 24 weeks that begins on the day that you received your loan and goes out either that next 8 weeks or that next 24 weeks. So as Sandy mentioned, if you got your loan before the Flexibility Act was passed, or I guess signed, so before June 5th, you have the option to either use the 8 weeks or the 24 weeks. If you got your loan after that, you are in the 24-week category. You don't have the option to go back to 8. So starts on the date you receive the loan funds and goes out either the 8 or 24 weeks. The alternative payroll covered period is an option for employers that have payroll periods that either run on a bi-weekly frequency or more frequent than that. So if you are someone that pays your employees semi-monthly or monthly or anything that's less frequent than bi-weekly, this is not an option for you. But for those of you that are in the category that are allowed to use this, this does a couple things for you. So one, by shifting to this alternative payroll covered period, potentially you can include a little bit more dollars in there depending on how your payroll periods fall. Given that now we have this 24-week option, that's not as big of a deal for most companies, but what it can help you do is just make it a little bit more easy from an administrative perspective to pull the reports. So if anybody has spent some time at this point looking at the actual application for forgiveness, what you'll note is that they didn't make it very easy. So as Sandy mentioned, the goal of this program was actually to provide grants, not to provide loans, but they've made it very, very difficult to fill out this application for forgiveness and turn it into a grant from a loan. So there's about 10 different periods of time, either dates or date ranges, that you could be pulling information from as far as how many people you had on the payroll and what their wages were. So it's a lot of information to pull. This alternative payroll covered period, it allows you to line up your covered period with your pay period dates and just makes it a little bit easier to do some of that administration.
Kate, I do have a question that is appropriate here.
Yeah.
If your payroll costs equal or exceed the PPP loan amount, can the entire amount be forgiven even if you reduced FTEs?
Potentially. You'd have to kind of work through the math on that. So we were actually internally kind of talking about that last week. And the way that the calculation works, and I'm just going to flip back here. So the way the calculation works, you take your payroll dollars plus your eligible non-payroll dollars and get your total dollars. If you had this total eligible cost up so high that once you take out the FTE reduction, your modified potential forgiveness is still above that PPP loan amount, it is possible that you could have it all forgiven. It's going to depend on the specific circumstances, though, of just how many dollars you spent and just how large of an FTE reduction you have. So you definitely need to spend some time kind of working through the math on that and see what it looks like for you. The other thing I'll get to here in a little bit is this FTE reduction. Potentially you could meet the safe harbor for that, which would then negate any reduction that you could have there. So two possible ways that you could have a reduction at a point in time in FTEs and still obtain loan complete forgiveness. Good question. When you are looking at those payroll costs, you do this $100,000 annualized limit. So if you are using the 24-week covered period, that's going to be $46,154 per employee that you're going to be able to include in this forgiveness calculation. You will start out with gross pay to employees. Add into that the company paid health insurance, company retirement contributions, and the state unemployment taxes. Unfortunately, some of the more recent guidance has indicated that the non-cash payroll cost, so the health insurance and retirement contributions, the things that aren't actually going directly to somebody as far as W-2 wages, those are not able to be included for owners that are also employees. So if you are an owner that got wages, those wages will count, but any sort of benefits that the company paid on your behalf would not be included in this payroll amount. All right, if we shift down a little bit and talk about the eligible non-payroll costs then, here you are going to use that standard covered period. So starts on the day you received your loan, goes out either the 8 or 24 months. And the types of things that you can include here are interest on real and personal property. And actually we should update this slide. So originally it was mortgage interest on real and personal property. The most recent guidance did clarify that to say any interest on debt that was in place prior to 2/15/2020 will count. So was a little bit confusing before what mortgage interest on personal property was and how that would relate to a line of credit, but that's been clarified and relaxed. So any interest on long-term debt that you would have had prior to 2/15 counts. Also rent on real and personal property, and then utilities. And again, keep in mind this 2/15 date. Idea is to allow businesses to continue operating as they were, not provide funds for expansion and investment. So 2/15 is kind of the date that they put as a line in the sand to say anything before that is pre-COVID, and we want to help you pay for that stuff. Anything after that, we're going to count as post-COVID, and we're not here to fund those investments.
Kate, will you remind us, is cable included in utilities?
Good question. They have not laid out anything specific to cable. So they did provide a list of some utilities that could be included. Cable was not on that list. It does not state if that list should be taken as examples or if that list should be taken as an all-inclusive list. So particularly this gets a little bit difficult if you get your internet service delivered to your facility through cable. Internet would be considered a utility. To the extent that they're bundled, then you get in this question of, are you supposed to break it out? So I'd say that's one of the areas that is gray. We could potentially see some additional clarification on that. Barring any specific guidance saying that you can't include it, we would err on the side of including it and then just kind of see where it goes. So I think that's one of those things that hopefully, given this 24-week covered period as opposed to the 8, people won't quite be on the fringes of that as much as they would have been previously. But certainly that's one of the areas that we are hoping for more specific guidance. All right, I wanted to talk a little bit more then about the wage reduction and FTE reduction. So let's talk wages here. So I had mentioned that if you had any reductions greater than 25%, you've got a reduction to your forgiveness. So anything up to and including 25% is kind of a freebie. You don't get dinged on that. Anything above that is going to be a dollar for dollar reduction to the amount of forgiveness. There is an exception here that if you had employees who earned over $100,000 in 2019, you can exclude them from this reduction calculation. You would not include them from the original payroll dollars in step 1, but you would exclude them from this wage reduction calculation here in step 2. So look back at all of your pay periods in 2019. See if in any one pay period, if you annualize that out for the full year and that comes up with over $100,000, if so, you can throw those folks out of this reduction calculation. The safe harbor, we've mentioned a couple times here, but reminder, if you have reductions and you restore that compensation level to the pre-COVID amount by the end of the year, then you don't end up taking any reduction for the wages. So key dates here would be if the reduction was between 2/15 and April 26th, and then you brought it back up to the pre-COVID of 2/15 level by 12/31, then you meet this safe harbor. Again, this is where lots of dates gets pretty confusing. You definitely want to go through and schedule all of these things out.
So Kate, with that 100,000 kind of annualized pay, can that be paid within a couple weeks, or does that need to be spaced out?
So the $100,000 here is talking about in 2019. So if you had any single pay period in 2019, that if you annualize that pay period and that ends up being over $100,000, you can exclude them from this calculation. So it would be one pay period that annualizing it gets over $100,000. So this could mean if you had somebody that, you know, earned say $90,000 for the full year, but there was a bonus in one pay period, if you take that bonus pay period and annualize that and they're over $100,000, then you can throw them out of the calculation. All right, let's slide over and do FTEs then. So FTE stands for full-time equivalent. This is calculated off of a 40-hour work week. So anybody that works on average 40 hours per week or more counts as one FTE. You don't get any extra credit for people that worked more than 40. If you had somebody that works less than 40 hours on average for their weekly amount, you're going to take that average weekly amount divided by 40. That's going to get you the proportional FTE that that person represents. So you're going to list out all of your people, all of their weekly hours, do the math, add them up, and that's going to be your FTEs. So you'll compare that for the covered period back to a prior reference period. You do have a couple of different options that you can use for the reference period. So again, lots of dates here. You're going to want to see what those different reference period options are. Choose the one that is most beneficial for you. If you still have a reduction in your covered period, once you compare it back to that base period, that is going to result in a reduction on a pro rata basis to the amount of forgiveness that you'll be able to receive. The same safe harbor applies here though. So if you have a reduction between 215 and 426, if you bring it back up by the end of the year, then you will not end up having a reduction for FTEs. There are a lot of different exemptions to this FTE reduction, and I think we're going to go into some of those here in a little bit, but a couple other ways that you might be able to skirt around these FTE reductions. I think that this is probably going to be an area that will hang up people the most here, given that we've got a lot more flexibility on the dollars. I think this FTE calculation is probably going to be where we start to see more of the problems cropping up as far as why folks aren't able to achieve full forgiveness. All right, so that's kind of the overview of the calculation. I am going to shoot it over to Mike to talk about some best practices.
Thank you, Kate. Appreciate that. So I guess one of the items we want to kind of talk through here is maximizing the forgiveness amount. The when it was originally 8 weeks as far as the covered period with which we had to spend the forgiveness funds, certainly I think almost everybody was really focused in on making sure to maximize the forgiveness. Hopefully the business that you are in, the industry that you're in, the 24 weeks allows for ample time to spend all of the PPP funds and to get it 100% forgiven. We still did want to kind of walk through some of the strategies here. If you wanted to stay with the 8 weeks, as Kate had mentioned earlier, it's basically an 8 or a 24 weeks, as long as you were funded prior to June or to June 5th. Now, why would you stick with the 8 weeks? Well, if you're anticipating some sort of FTE or wage reduction in the remainder of the period, then that 24 weeks could actually come back to kind of not be a great I guess decision for you if your FTEs are going to go down. So let's kind of look at a couple ways that we might maximize forgiveness. So number one really has to do with the payroll expenses. And I think those of us that are on the call here that are accountants, we like to kind of start off by thinking in terms of accrual basis or cash basis. And we're always kind of curious, all right, so as I'm thinking through spending this money, how do I account for it? Am I accounting for it kind of on an accrual or on a cash? Well, the short answer is you get to do it both ways, which I think gets very confusing for everybody. So think of it as two completely separate buckets. So we've got the 24-week period of time. So basically all of the payroll cost that you spend, that you pay during the 24 weeks, you get to include that. So something that was the last pay period that the employees actually earned the payroll prior to the 24 weeks starting, but you paid it just into the 24 weeks, you get to include that because it's two separate buckets. It's paid and incurred, but not each cost does not have to meet both, right? It has to meet either. It's paid or it's incurred. So you got the first bucket of all the costs that you've paid during the 24 weeks. And then if you think about the end of the 24-week period, now we get to include items that are incurred, but were not paid during the 24 weeks. Now the paid during the 24 weeks is pretty straightforward, as long as it's paid in the 24 weeks. The incurred during the 24 weeks, there's another kind of stipulation that you get to include the amounts that are incurred as long as they were paid in your next regular payroll cycle. So if you get to the end of the 24 weeks and your particular payroll cycle happens to have another 5 days in the 24 weeks, but then 2 weeks later, you pay that payroll. So as long as you pay it in that normal cycle, you get to then accrued the 5 days within your 24 weeks. So it really is on the front end, anything that was incurred before the 24 weeks, but paid in the 24 weeks spills into the 24 weeks. And anything on the back end that was incurred and then paid in that next normal payroll cycle also gets to be, I guess, included in that 24 weeks. So it really is truly cash and, I guess, accrual from a, I guess, an accounting basis. So if we think about bonuses and hazard pay, going back to the first point, right, as long as it's paid within that 24 weeks, really doesn't matter when you're saying that they incurred the hazard pay or to what period you're really attributing the bonus for, as long as it's paid within the 24 weeks. This is actually pretty important. At one point, we were uncertain whether they were going to tie kind of some limits back to kind of normal compensation, that we couldn't incentivize people more during the 24 weeks or during the 8 weeks than what they were pre-COVID-19. Actually, in the FAQs, it's been really, really clear that, in fact, it's almost encouraged, right? They really want to get as much money into the employees' hands as possible. So clearly, if we want to maximize forgiveness and we're going to fall short, then bonusing some more money out or having some hazard pay as a premium would be a way, I guess, a strategy to spend more of the PPP money. Profit sharing contribution.
Mike, a quick question on bonuses, and then I have a few others that I think you might get to, so I'm going to hold off on asking those.
Okay.
But if you pay quarterly bonuses, so the actual bonus wouldn't be paid the next payroll, what if you pay quarterly bonuses, so the actual bonus wouldn't be paid the next payroll after the 8 weeks ends?
Yeah, that's a very good question. So there's not, that exact question has not come out in the FAQs. So what we have to go by is just the actual application. So the literal reading of the application basically says you get to include payroll costs that were incurred during the 8 weeks or the 24 weeks, but not paid, as long as they're paid on that next payroll cycle. So we are not interpreting that to mean the next payroll cycle for that particular expenditure. We are interpreting that to mean that there's flat out the next payroll cycle. So I do think folks that run into that scenario should call up their payroll provider, or if they're doing it internally, they should go ahead and make sure that any amounts that fit into that kind of they were incurred but not paid, add that to that next payroll subsequent to the 24 weeks. Now, personally, if it's me going through this, if I've already got to modify kind of how my payroll is going to normally work, I would just go ahead and move it all the way into the 24 weeks anyways. But so it is not a next payroll cycle for that expenditure. It is an absolute, only that next payroll pay is going to count. So the profit sharing contributions here, very similar to the bonus in the hazard pay, right? Think in terms of it doesn't have to be incurred. It just has to be paid during the 24 weeks or during the 8 weeks. So one of the scenarios that we're thinking through here, and this might be fairly unique, but still, I mean, it certainly could fit out there. If a company typically has some sort of profit sharing contribution, and it's based upon their annual performance, and so they have a profit sharing contribution that they were going to be making for the 2019 tax year, but because of COVID-19 or just whatever, kind of had paused, right? And they haven't made that contribution yet. And they said, hey, it's just a good business decision. We think we should still go ahead and make that contribution. Making that contribution during the 8 or 24 weeks is really going to be a great strategy to increase the amount of PPP funds that are used. This one has an extra benefit to it in the sense that if that profit sharing contribution is being made to a qualified plan, then as long as it's not an owner, the owners are just capped off at the $100,000. But if it's to a qualified plan and it's to a non-owner, then we're not limited to this $100,000 annualized limit. The $100,000 annualized limit is for cash compensation, and a profit sharing contribution to a qualified plan would just simply be a retirement benefit, and that's not going to fall into that $100,000. So you could actually have employees get the $46,154 during the 24 weeks, make a profit sharing contribution for a prior period, but pay that during the 24 weeks, and actually be above $46,154 for that particular employee. Again, as long as it's into a qualified plan. If it's not into a qualified plan, then it's going to flip into the cash compensation for that individual. Let's talk a little bit about rent. Per the instructions, there really is not any limitations as it relates to rent. So if we called up our landlord and said, hey, I'm not sure where this is going, I want to pause on making my payments. A lot of landlords were giving some, basically allowing people just not to pay the rent. So if we want to load up on the 24 weeks and pay some catch-up rent, that would be a great way to kind of add to the PPP monies. Also, there's not a restriction per the instructions on the prepaid rent. This is one that I wouldn't be surprised if in some sort of FAQ or some sort of interim final rule that they don't take away the prepaid rent kind of option. But per the instructions, it does not prohibit prepaying rent. For interest, it's very interesting in the exact same instructions, one line down where they talk about interest, they specifically call out we are not allowed to prepay interest. So prepaying rent appears to work, prepaying interest does not. If for some reason we paused on making our interest payments to the bank or whatnot during this kind of period that everyone's waiting to see what the heck is going to happen, to the extent that you're making catch-up interest payments during the 24 weeks, that will count. So just a couple of ideas out there as far as how to try and maximize the forgiveness. As you're working through all the nitty-gritty details of trying to maximize the forgiveness, we're really encouraging everybody just take the time as you're going through the calculation to save the right documentation. If you're over $2 million in total PPP monies, then that will be audited. So saving the documentation is going to serve you very well. Let's be honest, there's probably not that many people on this call that are over the 2 million. Where we believe that this is going to be very relevant is the banks are going to get this application. They're then going to submit information to the SBA and hear back from the SBA whether it's forgiven. So it's not the banks making their own decision, right? They're handing the information off to another party. Whenever you're in a situation where you're handing the information off, you certainly want to have more information than what you need, right? So we are anticipating very appropriately the banking community being very, very thorough and asking for information and really kind of understanding where all the numbers are coming from. So I'm anticipating that needing really good documentation, really good kind of books with tick marks and everything being provided to the banker. So as you're going through this, we're really just encouraging everybody, just make sure to save the appropriate documentation, which just save you a lot of time in the long run. You could advance the slide, Kate. Thank you. Just a couple of tax, considerations we wanted to go over with everybody. So there's a lot of debate as far as the deductibility of the expenses. So if you think of version 1.0, they wrote the law, and the law specifically said that forgiveness will not be taxable income. So as a starting point, typically under tax code, if you have $100,000 of debt forgiven, that's $100,000 of taxable income. Well, specifically in the CARES Act, they said that is not going to be the case. We are not going to tax the $100,000 of debt forgiveness. But they were silent as to the expenses. So then later on in an interim final rule, basically the SBA and Treasury has come through to say, got it, we can't change the taxability of the debt forgiveness, but now we're not going to allow the deductibility of the expenses. So if we get a $100,000 SBA loan, and we spend $100,000 on payroll, we get 100% of the $100,000 forgiven. And the way this is going to work is that we are not going to have $100,000 of taxable income as a result of the forgiveness, but we're also not going to have $100,000 of payroll expense because the expenses that those funds were used for are not going to be allowed. We're pretty certain that this was really not the original intent in the CARES Act. If you think about the outcome of taxing the $100,000 debt forgiveness and allowing the payroll expense, that gets you back to zero. So if now we're not going to tax the $100,000 of income and we're not going to allow the deduction for the $100,000 of payroll expense, we're also getting ourselves back to zero. So it seemed to be kind of silly to put that in the CARES Act if all we're going to do is now disallow the deductions. We're still back at the same starting point. So pretty certain that in the CARES Act, they really wanted to give the benefit to the companies to have, here's this free money, and oh, by the way, you still get the deduction for the expenses, and it's not going to be taxed, right? Really the best of both worlds. There is some debate going on right now. I would, in all of our modeling, I would plan to not get that tax deduction, but there is some debate going on right now that potentially they're going to write an additional rule that will basically allow the deduction for the expenses. But as of right now, the amount that we use on payroll, rent, utility, leases, interest that is forgiven is not going to be deductible on our tax return. Sandy already mentioned this earlier. This really is a big deal, the deferral of employer Social Security taxes. Now, this is just that 6.2% employer portion, but essentially we get to defer all of those monies up until 12/31/2020, and then pay half of that December 31st, 2021, and half of that 2022. Originally, it was thought that we could not do both the PPP loan and the deferral. We can. There was actually a couple iterations there that had to do with when exactly the loan was going to be forgiven, but all that, when all the dust settles, has been taken away by the Flexibility Act, that we get to defer everything through 12/31/2020, regardless of if we have a PPP loan or not. We just have a slide here, I guess a mention on the slide of the employee retention credit. Really, we just want to bring this to everybody's attention, just in case you did not get a PPP loan, just in case you have decided not to get a PPP loan, make sure to look into this employee retention credit. It's maxed out at $5,000 per employee, and it's not $5,000 per quarter or anything. It's just a total of $5,000. So you can kind of back of the envelope quickly calculate kind of what the amount of that might be. But essentially, if you're over 100 employees, you get a credit for 50% of the wages. You're paying somebody to stand around. If you're under 100 employees, then the retention credit ends up to be 50% of the wages for your entire workforce. So it really can be a fairly good plan B for individuals with less than 100 employees, and they did not get the PPP loan. So it's really kind of the, I guess, place where we're seeing that might work. All right, so we've kind of gone through some ideas as far as maximizing, gone through kind of some of that tax items. So really, what should I do next? I can't stress this enough. Get your hands on a calculator. We have a calculator out there. You can find it here. We've got the link. We'll provide an email post this webinar that provide the link to everybody. But get your hands on a calculator. When you open up our Excel spreadsheet, Kate's been the mastermind of this. It's got a lot of tabs to it, and you're going to open it up and be like, "Wow, this thing! I really don't want to do this, right? I'm just going to take the instructions and I'm just going to work through this." My bet is that an hour, 2, 3 hours into trying to work through it, you're going to start to say, "Wow, there's like 6, 7, 8 different date ranges I need to keep in mind here. I need to keep a different date range in mind for the FTE reduction versus the wage reduction versus my 8 weeks or my 24 weeks. And see, if I have payroll paid every 2 weeks, I can choose this alternate covered period, but the alternate covered period only relates to the payroll cost. It doesn't relate to the non-payroll costs, right? To the rent and the utilities and the interest. And your head's just going to start to spin. And if you really take the time to start off with a calculator and methodically just work through the calculator, it will help you keep everything straight, all these different nuances in the calculation. And then it really will pay dividends to the extent that you have excess funds being spent and you're really comfortable that it's all going to get forgiven. I think that will really provide a lot of security, a lot of just kind of contentness, right? As you say, all right, awesome. I expect to get 100% forgiven when I submit the information to the bank. But also, if you go through this calculation and you end up coming to an end answer where it's really not going to be forgiven, right? 100% of it is not going to be forgiven. Then you're going to be able to see in this calculator, well, where is that reduction coming from? And then you can focus right in on that reduction and then reverse engineer that reduction, right? Kate talked about some safe harbors, safe harbor on the wage, safe harbor on the FTEs. There's also some other scenarios as far as if you offer somebody a job and they refuse to come back, that does not count against you. If you released somebody for cause, that does not come back. So there's all kinds of nuances in this calculation that just can't stress enough. Get your hands on a calculator. We've got ours out there. It's free. You get to just use it. It will really pay dividends. It's going to seem like a monster, but it really will pay dividends for you. So as you're looking through these different scenarios, the one item here, because certainly we get to get creative, and if we don't have, if we want to just return the unused funds, it just makes us nervous holding on, right? We can do all those things we have listed there. But first and foremost, we just want to call everybody's attention to just good old-fashioned business sense, and maybe a way to kind of describe what do we mean by that. If I've got a workforce that I'm not going to get to use all, or I'm not going to get to use all my PPP money, and I really want to maximize the forgiveness, and I'm going to give everybody a $1,000 bonus, right, to try and use that PPP money, right? That probably is a really good business decision as far as the goodwill with the employees and really just kind of really using the funds for what they're supposed to be used for. Well, let's go through a scenario where we've already given the entire workforce a $1,000 bonus, and we've already gotten the goodwill from using this money as much as we possibly could. Would we decide to do a second $1,000 bonus for everybody, or would we rather just hang on to the money, right? We really don't know into this fall, into the winter time, if there's going to be another outbreak, right? We just don't know what the future brings here. So we would say that once we've achieved all the goodwill we can, once we've maximized all the strategies, it's not a penalty to not have money forgiven as long as we didn't spend it. So if we didn't spend $1,000 and we don't have $1,000 forgiven, and that $1,000 ends up to be a 5-year 1% loan, that 5-year 1% loan is a better end answer than just simply spending money that we wouldn't have otherwise spent during the 24 weeks just for purposes of getting the forgiveness. So those are the things that we wanted to call to everybody's attention, a bit of an update, how the calculation works, and then here's some kind of strategies to maximize and as far as what to do next. And I believe we've got some time to open up questions.
Yes, we do. Thanks, Mike, Kate, and Sandy. And I will just put these questions out there, and then whoever's most appropriate to answer those can. So I know, Mike, that you did touch a little bit on making sure that people document everything as they go. A very specific question, though, about documenting FTE exceptions on the application.
I can take that. So right now, there is not a specific place to document in a lot of detail those exceptions. The form itself has a couple of different like worksheets that it provides where you would list out all of the employees and their wages and then what their FTEs are. At the bottom of worksheet 1, there is a little box that you just put the total number of FTE exceptions that you have in there. So on the form, on the application itself, that's it. It's just this one box. I believe that there's an error in the application that should have a similar box on table 2. Right now, it's just in table 1. So there isn't a place to even document the FTE exceptions for anybody that makes over $100,000, even though the instructions say that you should be able to do that. So I do think that, well, we are expecting a new application to come out. The current application was prior to the Flexibility Act. It does not include the 24 weeks as opposed to the 8 weeks. It doesn't include the 60% versus the 75%. So we will sure we'll be seeing another application. Hopefully it will help make some of this a little bit easier. But where we are right now, there's just one little box to put the total number. You will need to keep separate documentation on your own and provide that to your banker when you submit this. But there isn't really a way to do that within the application itself. Mike talked about our calculator. If you use our calculator, we do have a tab on there specific to the FTE reduction exceptions, where you can select which one you're taking the exception for. So it'd be a nice way to just kind of map all of that out and document the reasons. And then you'd want to keep also the payroll records as far as, notes that were in the employee file that, give the source documents for that as well.
A couple of questions that were sort of in the same vein, so I'll ask them together. If we laid off employees from March 16th to May 4th, will that affect the FTE? And likewise, if I have an employee that quits, do I have to rehire to keep the FTE the same? The employee end date is July.
Yeah, so the item, as far as the safe harbor, so one of the things that we want to kind of keep in mind is, when did the reduction happen? So if the reduction happened during February 15th through April 26th, we're going to be provided this mechanism to cure it. So if I kind of go backwards here and kind of start off with the question, what was the date that the reduction happened within the question, Miss Julie?
To that question, sorry.
Yeah.
It was March 16th to May 4th.
Okay. So it really matters when that reduction started. So if we're saying that this reduction started in this February 15th, April 26th date, then it's going to be eligible for the cure period. And then I think the question is really getting after, but the reduction stayed into my covered period. So now it's reducing the FTEs during the covered period. So starting answer to say, will that reduce our forgiveness, as far as will it give the potential for an FTE reduction, the forgiveness calculation? Absolutely. If the FTEs are reduced during the 24 weeks or during the 8 weeks as compared to sometime prior, there's all kinds of different options as far as kind of that base period. But yes, it will reduce it as a starting point. So then we say, okay, we've got the potential for the reduction. Then we go to, but if, as long as that reduction occurred February 15th through April 26th, and we bring them on by December 31st, 2020, then we get to eliminate that reduction. And I think a lot of people are reading the instructions that say I have to bring them on, they have to be on my payroll as of December 31st, 2020. It is not an as of December 31st, 2020. Our interpretation is every payroll cycle you have, whether that be every week, every 2 weeks, twice a month, once you restore those FTEs at a period in time after your 24 weeks, but before December 31st, 2020, then you get to go back into the calculator and essentially eliminate that reduction. So our starting point is, yes, mathematically we'll have a reduction. We're given this opportunity to cure that reduction under the safe harbor at some point prior to December 31st, 2020. In addition to all of that, there are these additional exceptions as far as, and I've got the instructions in front of me here, that there are these exceptions based upon if you release them for cause, if the individual voluntarily left or voluntarily reduced their hours, if you offer them a job back and they just refuse to come back. Then those are additional ways that we get to go back into the calculator and eliminate the negative effect of that FTE reduction. Now, a couple of questions there. Hopefully I kind of covered the majority of it, if not all of them.
Yeah, I'll just add to, with those exceptions that Mike went through that are part of the application, there were a couple of more that were included in the Flexibility Act, which again, the application has not yet been updated for the Flexibility Act. Sandy did mention these at the beginning though, but it's basically if you've got, if you're unable to return to the level of business that you were doing before because of government restrictions where you have to limit your capacity, you're not going to be harmed for not being able to hire folks up to that level. In addition, if you just aren't able to find people with the right skill set, if you can document that you've looked for those folks and haven't been able to find those to bring your FTEs back up, you can get exceptions for those as well. So definitely a number of exceptions to take a look at if you are starting to fall into that category of having an FTE reduction. Go through and see if you can meet any of those exceptions.
Thank you. Does it matter that the loan application and the FTE count are different?
I'm not sure what that.
There's going to be two. You're going to have your base period, which if we walk through the instructions or walk through a calculator, it will help you determine what that base period is. And that's basically pre-COVID-19. And then you're going to have your FTEs during the 8 weeks or your FTEs during the 24 weeks. It really is just, for the starting point, it's very straightforward. It's just a comparison of those two numbers. If I had 100 FTEs in the pre-COVID period and during my covered period, during the 8 weeks or during the 24 weeks, I have 80 employees, 80 FTEs, then I'm looking at a 20% potential reduction. Where it gets really complicated is really when we kind of start saying, okay, I have these 20 FTE reduction, 20% reduction, where can I start to get relief from that 20% reduction? But really just the base period as compared to the, covered period as a starting point.
Just a bit of clarification on the owner's profit sharing contribution to a qualified plan can be used as forgiveness. That was somebody just needed some clarification.
Yeah. Sorry if I got somebody heard me kind of say that. I definitely missaid it if I was saying that profit sharing for owners can take you above the $100,000. The $100,000 is a strict limit for the owners, whether that be a healthcare cost, whether that be a retirement cost, whether that be SUTA. The employer, any sort of owner, is truly limited at that $100,000 annualized. So it's only the cash compensation. Nothing else counts for the owner. The other thing I'd called everybody's attention is this notion of it's not an automatic $100,000 for the owner. If an owner only made $80,000 in 2019, then it's not $100,000. They're limited to the $80,000. And our interpretation of the rules is if you have $80,000 of comp in 19, then you would think, okay, well, do I get to use that extra 20 for things like healthcare insurance and for things like retirement? In the absolute reading of the instruction, no, you do not get to add back any of those non-cash compensation items for an employer. So an owner of a company truly is just limited to the lesser of their 2019 compensation, which can come in a multitude of different ways, a Schedule C or on their W-2 or just a K-1. But whatever their 2019 compensation was, and that really is focused in on what was subject to payroll taxes. So run through a W-2 and subject to payroll taxes, or coming through on their tax return and just subject to self-employment taxes. But whatever their 2019 amount of comp that was subject to employment taxes, so that or $100,000, whichever is less, and you do not get to include any of these non-cash compensations for the owners. And there's no threshold either. So it would appear as though somebody that owns 0.1% of a company, they are an owner per the current instructions.
Just a couple more questions here that we have in the chat box. I know we're at our hour time frame, so we certainly invite everybody to hear these questions. They're probably valuable to everybody, but we do understand that we have taken you to the hour that we said. So bear with us on these last few. If we manage to spend the entire PPP loan prior to the end of the 24-week period, do we need to wait until the 24-week period runs before applying for the loan forgiveness?
So you will have the option of either the 8 weeks or the 24 weeks. You don't get to pick something in between. So if you use 8 weeks and you spend enough money during that time frame on the allowed expenses and you don't have some of those other reductions to worry about, I'd say go with the 8 weeks. no need to drag it out and have something maybe pop up later if you know that you're very comfortable with where you are on forgiveness for the 8 weeks. If you don't get there in 8, you do need to go out the 24. There is not an interim period. As far as the timing of when you will submit your application to your bank, the rules have that they allow for up to 10 months. So the end of your covered period, whenever that ends, you've got 10 months from that date to submit the application to the bank. They've got then 60 days to take a look at the application and all of your documentation that you've provided, make their kind of recommendation on what's to be forgiven, send it over to the SBA. They've got an additional 90 days before they can have to come back with their ruling on whether they're going to go with the bank's recommendation or ask for more information or require something else. So you get a couple of options in there. There isn't necessarily a rush to go get it forgiven, but you really do kind of have that 8 or the 24 weeks, not an interim period.
Just one item to add there, because as Kate said, you have 10 months after the covered period to submit your paperwork. There really isn't an election, if you will, as far as choosing the 8 weeks or the 24 weeks. You're effectively making that choice by how you submit the paperwork to the bank. If you submit the paperwork with 8 weeks, you've elected 8 weeks. With 24 weeks, then you've elected the 24 weeks. So because of that 10-month rule, companies are able to maximize their expenditures during the 8 weeks, do everything they can during the 8 weeks to maximize it, and then let the next 16 weeks run. So go the full 24 weeks, and then also evaluate it at the end of the 24, and then submit your paperwork, choosing which answer is better. So if you go out the end of the 24-week covered period, you're still going to be within that 10-month rule as relates to the end of the 8-week period. So as long as you're maximizing things during the 8 weeks, I just want to caution people by kicking the can too much, because there's some things you just need to do during the 8 weeks that you're not going to be able to go back and like cure, right? So do as much as you can during the 8 weeks with this 10-month rule. You can, after the fact, then go and calculate it both ways and just choose whichever way works better for you.
What about interest on NP shareholders? Does it qualify?
What was that? Interest on?
NP? Nonprofit, maybe?
And maybe it's a no payable.
No payable.
A shareholder. Yeah.
So related party interest?
Yeah, I think it's like a shareholder loan, right? So we're paying interest to a shareholder.
Note payable.
Yeah, notes payable.
Mm-hmm.
We haven't seen any sort of related party kind of restrictions. And this would go for interest. This would go for rent, so that the owner owns the building and they're paying themselves rent. Seems to kind of fit into that same category. We are not seeing any sort of restrictions on related party type items, whether that be rent or whether that be interest. We are advising that a written agreement and a history of making payments should be in place as of February 15th. If you don't have a written agreement, but you do have a history of payments before February 15th, maybe the bank's going to allow that. But best case scenario, you both have a written agreement and a history of payments prior to February 15th. If you really don't have a history of payments and you don't have a formalized written agreement for this note payable to then start making interest payments during the 24 weeks, that might be something fairly difficult in the bank review to kind of be able to explain, because how do we prove that it existed as of February 15th, as far as the interest rate and everything.
So the paid and or incurred applies to payroll only and does not include the non-payroll allowable expenses. I think that was a point of clarification somebody was looking for.
It applies to both. So the paid and incurred, kind of the same wording as for the non-payroll cost. So for our rent, if all the rent we pay within the 24 weeks, we get to take all the actual cash payments. But then at the back end of the 24 weeks, if the is, let's say we got 15 days, half a month, it falls within our 24 weeks, but we're not going to make that payment for another 2 weeks after our 24 weeks. Kind of the same thing as the payroll. As long as it's paid on or before the next kind of reoccurring pay date, then yeah, you get to basically accrue for those costs back into the 8 or back into the 24 weeks.
If we have followed all the rules and the presumptively maximized PPP forgiveness over 2 months, why wait 24 weeks?
There's no reason to.
When you decide on 8 or 24 weeks, and when do you apply for forgiveness? Or when do you decide on 8 or 24 weeks? I think you answered that since we've gone through this.
Yep.
And really, I think that the last question that I do have is somebody who has a very specific situation that they'd like to talk about. So if it's okay with you, can I put you in touch separately from this?
Sure.
Absolutely.
Perfect. Any other questions? Oh, once again, Mike, Kate, and Sandy, thank you so much for all of your insights on this. And you're right, having sat on just a last week with you to see all the changes and updates already, we definitely appreciate that. Again, to all of our participants, thank you for joining us. Again, I did record this, so we will have that downloaded. We will have that saved on the Chamber's website. And I will send you the link to all of that. Included in that will be the link to the calculator that they all talked about, which is an extremely valuable tool. So as soon as you get that link, if you haven't been working inside of that calculator already, I certainly recommend that you take a chance to do that to really help yourself keep ahead of things. So again, thank you for your participation today. Thank you to our presenters. We are grateful for your partnership with the Chamber, and have a great afternoon, everybody.
Thank you.
Thank you.
Thanks. Bye.
Thank you, everybody.